Here's I'm glad you brought up the wage issue, because, Joel, if you get weak wage growth, that's going to tell Wall Street today you're going to get an earlier rate cut. That could send the markets the other way.
Well, I mean, I don't think we're going to see a rate cut based on today's numbers because, again, as everyone's mentioned, we've got a lot of revisions coming into this thing. I'm focusing on participation rate. As we have an aging demographic in our country, we're going to see fewer people participate. I'm also looking at the temporary numbers in terms of what's going to happen. I think as AI starts to kick in, we're going to see a couple things happen. We're going to see more, we're going to see the outsourcing jobs perhaps decline. We're going to see the temporary jobs also decline. So I'm focusing on a couple numbers, behind the headlines in terms of what's going to happen this year. This is going to be a very interesting year as we see 4.3 million people roll off or potentially roll off because they're going to reach retirement age. So we've got about 60 million to 70 million baby boomers who are already past retirement age. Many of them are already past retirement age. And sooner or later, they're going to drop off. This participation rate is, I think, going to be a big number for this year and the next year.
And I want to pick up on something that, Charles, you were talking about in the last part of the show, and it's that annual. Tie this back to the Fed, because, again, if you saw weak wage growth, that would signal to the market you're going to get a rate cut earlier. We didn't get that in this report. In fact, average earnings month to month up 0.5%. That's above the estimate. And then year over year, that number was higher as well at 4.1%. So that's where the Fed's going to have to choose.
Right. Well, it doesn't appear it doesn't appear today's jobs report is going to have them move at all in their perspective in terms of when they may have the next rate cut. So, they didn't expect. We haven't been expecting a rate cut anytime soon. That's not going to change based on this jobs report. What will be interesting to see is how the increase in expenditures, whether we're going to see any incentives, and I wrote an article recently talking about incentives that were done back in the 1960s that created a lot of job growth, a lot of investment back in. We've got the new sovereign fund coming in. So if we see more investment coming back into the market, that may be an impetus, maybe a driver in terms of seeing increased excitement in terms of job growth going forward. But right now, the government came down, social services will be coming down, and healthcare, I think, is going to remain stable. That's traditionally been where the big job